So you're trying to figure out how to pay for college, and the big question is, how much can I actually borrow? Is there a limit, or can you just take out whatever you need to cover the full cost? The answer is a mix of both, and it is governed by a set of strict rules that often leave students and parents confused and sometimes short on funds. You might have heard that you can't borrow more than your school's cost of attendance, but what does that actually mean? And why does your friend, who seems to have a similar financial situation, have a higher loan offer than you do? The system isn't designed to give everyone a blank check. It's built with specific caps to prevent overborrowing, but these caps don't always align with the actual cost of expensive universities. In this video, we're going to demystify student loan limits. We'll break down the hard federal loan caps based on your year in school and dependency status, explain how Parent Plus and Grad Plus loans fill the gaps, and discuss the very different world of private loan limits. Most importantly, we'll talk about the golden rule of borrowing. Just because you can borrow up to the limit doesn't mean you should. Understanding these numbers is the first step to making a smart, sustainable financial plan for your education. Let's start with the core of the system: federal loan limits for undergraduates. These are not one-size-fits-all. The amount you can borrow depends on two key factors: your year in school and whether you are classified as a dependent or independent student. This dependency status is determined by the FAFSA questions, not by whether your parents actually help you pay for school. Generally, if you're under 24, not married, not a veteran, and don't have your own dependents, you're considered a dependent student. Now, for dependent undergraduates, the federal loan limits are as follows. First-year students can borrow a total of $5,500 for the year. However, of that total, no more than $3,500 can be in the form of subsidized loans. Remember, subsidized loans are the ones where the government pays the interest while you're in school. For second-year students, the total limit increases to $6,500, with no more than $4,500 of that being subsidized. For third-year students and beyond, the total annual limit is $7,500, with no more than $5,500 being subsidized. These are the hard caps from the federal government. But there's a catch for dependent students whose parents are unable to borrow a Parent Plus loan. In that specific situation, the student becomes eligible for higher independent student limits. So what are those independent student limits? They are significantly higher. First-year independent undergraduates can borrow up to $9,500, with the same $3,500 subsidized cap. Second-year students can borrow up to $10,500, and third-year students and beyond can borrow up to $12,500 annually. The subsidized portions remain the same as for dependent students. This difference exists because the system assumes independent students don't have a family financial safety net. But wait, there's more. The limits we just discussed are your annual limits, meaning the maximum you can borrow for a single academic year. There is also a second, even more important limit called the aggregate or lifetime limit. This is the total amount of federal loan debt you are allowed to accumulate throughout your entire academic career. Hitting your aggregate limit means you cannot borrow any more federal loans, even if you haven't finished your degree. For dependent undergraduates, the aggregate limit is $31,000. No more than $23,000 of that total can be from subsidized loans. For independent undergraduates, the aggregate limit is $57,500. Again, the subsidized portion of that is capped at $23,000. It is absolutely critical that you track your running loan total against these aggregate limits, especially if you're changing majors, attending part-time, or pursuing a fifth year of study. You do not want to be a senior who suddenly can't get loans to finish their degree. A key pro tip here is to log into your account on Student Aid Gov at least once a year. They have a dashboard that shows you your exact loan balances and how much of your aggregate limit you have left. This is vital financial hygiene. Now, what if your school's cost of attendance is higher than these federal loan limits? This is a very common scenario at many four-year universities, especially for out-of-state or private schools. This is where PLUS loans come into the picture. For dependent undergraduate students, the gap can be filled by a Parent PLUS loan. These are federal loans taken out by a parent, not the student. The limit for a Parent PLUS loan is the school's full cost of attendance, minus any other financial aid the student has already received. So, if your cost of attendance is $30,000 and you have $20,000 in grants and direct loans, your parent could potentially borrow up to $10,000 in a PLUS loan. It's important to know that these loans require a credit check, though not an exceptionally high one, and the parent is fully responsible for repayment. For graduate and professional students, the gap is filled by a Grad PLUS loan. The annual limit is also the cost of attendance minus other aid. Grad students have their own aggregate limit for direct and subsidized loans of $138,500, and the Grad PLUS loans have no aggregate limit. Only the cost of attendance constraint. This is how graduate students can end up with $200,000 or more in debt. So, what about private student loans? Private loans operate in a completely different universe. They do not have the same standardized annual or aggregate caps as federal loans. Instead, a private lender will determine your maximum loan amount based on two things: the school's certified cost of attendance and your creditworthiness. You cannot borrow more in total from all sources than your school's cost of attendance. So, if your federal loans and other aid don't cover the full amount, a private loan can theoretically cover the rest. The lender will perform a credit check and, for most undergraduates, will require a cosigner. They will then decide the maximum they are willing to lend to you based on that credit profile. While there's no government-mandated cap, the practical cap is the school's official cost of attendance. The most important takeaway from all of this is that your maximum borrowing capacity is a combination of strict federal caps and the cost of attendance at your chosen school. But the most critical number isn't any of these limits, it's your future starting salary. A golden rule of thumb is to try not to borrow more in total for your entire education than you expect to make in your first year out of school. If you're going into a field with a typical starting salary of $50,000, you should strive to keep your total student debt below $50,000. This makes the debt manageable. Always borrow with the end in mind. Take only what you need, live like a student while you're in school, and use every tool at your disposal to minimize the principal you have to pay back later. Before we finish, a critical disclaimer: I am not a licensed financial advisor or a financial aid officer. The specific loan limits discussed are for the 2024-2025 academic year and are subject to change by Congress. You must always consult the official federal student aid website at studentaid.gov and your school's financial aid office for the most current limits and for advice tailored to your specific situation. Borrowing decisions have long-term consequences, and it is your responsibility to understand the terms of your loans and borrow only what you need and can realistically afford to repay.